for many of us, mortgage is the biggest loan we will ever have in our life. And we keep on worrying about how to pay it down faster, what things to do, what not to do. And it's a very big stress. Did you know that 60% of Canadians actually feel that upon retirement, their house value is going to help them get a second income? So it becomes very, very important for all of us to look at ways to reduce this debt as soon as possible. There are financial advisors. If you go online, there are so many people that would tell you, don't pay off your home. This is the cheapest loan you would ever get. I understand they are right, but is it right for all of us? I don't think so. It's right for people that want to take risk. It's right for people that have great cash flow. Sort of stress right for you. However, if you know the right way of reducing your mortgage, paying down that debt, then yes, it is the lowest interest debt you would ever get in your life. Today, I'm going to be giving you a few tips on how to pay off your mortgage faster. If you had plans to pay off your mortgage in 20 years, I hope after watching this video, you'd be able to pay off your mortgage in 7 to 10 years. Now, I don't want you to think that I'm an expert and I have paid off my homes in 3 or 4 years, and that's why I'm here to advise you. On the contrary, I have actually lived all the mistakes myself. So I'm going to try and give you those tips that have come out of my real life to make sure that you don't end up making those mistakes. So let's start with number one. I know nobody talks about it, but in Ontario, you pay almost 1.8 to 4% of the property cost in CMHC premiums. Canadian Mortgage Housing Corporation, that is an insurance basically that you buy to protect a mortgage or bank. You know, the lender says, I will give you this money. However, if you're not able to keep your commitment, I would like Canadian Mortgage Housing Corporation to pay off this loan. So banks are basically protecting themselves, and the insurance premium is paid by you. And that is called CMHC. So how do we avoid that? Okay, a lot of times you want to buy a house with 5% down, with 10% down. Well, make sure you don't buy your home until you have at least 20% down payment. Because after that 20%, you won't have to pay the CMHC fee. And you end up saving between 2 to 4% of the cost. So if you're buying a house that is worth $6,000, or nowadays a condo that's $600,000, you're going to end up saving about $12,000, close to $10,000 to $12,000 in fees if you have at least 20% down to pay down as down payment. All right, next, very simple tip. You all have probably heard that, but did you know that by making your payments bi-weekly versus monthly, you actually pay off your mortgage about 18 months faster? Okay, so you save 18 months just because you're making payments bi-weekly. Okay, the reason for that is because if we pay monthly, we actually pay only 12 payments in a year. But if we pay bi-weekly, we end up paying one extra payment each year. One extra payment each year actually reduces your 18 months, about 18 months in that 20-year period if you pay it bi-weekly. Okay, very simple yet very, very effective. Another thing is when you make your mortgage payment, that mortgage payment is made up of principal and interest. Now, the longer the term, the higher the interest. So if you amortize a $600,000 loan with the bank at, let's say, 4.8%, okay, that's like a 5-year closed mortgage rate. If you end up closing that deal for 30 years and you renewed it every 5 years, do you know that you almost pay $600,000 worth interest in those 30 years? So you're not only just buying a home for yourself, but you're actually buying a home for the mortgage company as well. So how do we avoid that? How do we avoid paying that $600,000 in interest? So one was biweekly payment. The second you can do is, my recommendation is make 2 extra payments each year. Take it like a bill, treat it like a property tax bill, and say that every year I need to pay 2 extra payments to my mortgage, which reduces almost 4.5 years of amortization time for your mortgage. Isn't that great? Very simple yet effective. Third, I have, this is my own theory. I know people get surprise money. That surprise money could be your tax refund. It could be your bonus from your job. It could be, a part-time job that you started, or a contract that you ran, or a consulting assignment that you just completed. Anything like that, which is basically surprise money for you. Try and put that towards the principal, because as you're putting down money towards the principal, you're actually paying lesser interest. All right, so that was tip number 3. I always recommend that you go and shop for a better rate. Every time your mortgage renews, I know it's so convenient to sign those documents, or just say yes on the phone, or tell your bank it's okay for me to renew for the same amount, whatever it is. Okay, even with the same lender, the same bank, you can go in, book your appointment with the manager and say, hey, listen, can I get anything better? Okay, so to give you an example, my mortgage, when it renewed, and I continuously renewed it for a locked-in period at a prescribed rate. And I went in and I spoke to my manager and I said, what would you do? What do you do? And he suggested that go for variable rate. And when I found out more, and you should do the same, find out the difference between variable mortgage and a fixed rate mortgage, and you'll be surprised how at the end of the 5 years, you would make a big difference. However, the key is to not reduce your payments. The key is to pay more towards your principal, okay? So always shop for better rate. If you can get a better fixed rate, go for it. That's your preference. I know I was scared for many, many years to go into variable rates. I'm comfortable now, but I wasn't in the beginning. So I wouldn't ask you to go for one or the other, but I would ask you to take a look and try and understand. In my previous videos, I've always recommended that 20% of your net income should be saved. Would you be surprised if I told you that many of us, we dip into our line of credits or refinance our homes or make high interest loans from lenders to take care of small things like, we need a new roof, or the air condition just went down on us, or the furnace is not working anymore, or the driveway is having trouble. So when you own a house, it comes with a lot of small things that are going to break down and cause expenses for you. So the recommendation I had, put away 20% towards your future. I'm not saying that you use that as your emergency fund, but here is my tip number 5. Whatever mortgage amount you have, take 10% of that, open an account, and put that money aside for all these last minute expenses. Just so you don't look for that high interest loan, or reach out to that line of credit, or use that credit card, which is on 18 or 19%. So the last tip that I would like to give you is, do not refinance. Do not have your home equity line pay for your dreams, your travel, your expenses that you could actually afford by putting money aside. All right, I'm going to show you a little graph so that it stays in your mind when you're trying to think of this message, and that is basically same points that I have just discussed with you. Here are my 6 or 7 tips. Pay down your mortgage biweekly as opposed to monthly. Here you are. These are all the suggestions that I have given you in this message. I hope you enjoyed this message. If you have suggestions, please do call me. I'm going to try and give you mortgage calculators that help you. I'm going to try and put that link in my comments below here, so that you can click on it and play with that calculator and see how fast you can pay down your mortgage by putting extra down every year, or by paying bi-weekly, or by having that additional payment come up towards principal. All right, I hope you enjoyed the session. Thank you, and see you again soon.